Hello and welcome back to the Basic Accounting series. This is a short video about debit and credit. Now, before we understand the concept of debit and credit, we usually use the abbreviations DR and CR for debit and credit in accounts. Now, debit doesn't even have an R in it. So, where does this DR or CR come from? These words are derived from the Latin words debere and credere, and hence we use DR and CR. Now, the original meaning of debere and credere is not really relevant in today's scenario. Let's quickly understand how the accounts are affected when they're debited or credited. Now, we follow double entry system of accounting, which means every transaction that we record in the books of accounts will affect minimum two accounts. At least two accounts would be affected, either debited or credited or both. So let's understand with the help of examples. Received tuition fees of rupees 5,000. So here the cash is coming into the business. So cash account debit to tuition fees. Cash account debit to tuition fees credited with 5,000 and cash account debited with 5,000. Now we've already covered how to pass journal entries in the previous videos. So if you do not know the basic rules of passing the journal entries, you'll have to watch those videos first. Salary paid to Mr. X. Now salary is an expense, so it will be debited. Salary account debit 2,000 to cash is going out. Cash is going out, so it is credited with 2,000. Paid off loan rupees 5,000. So loan amount will be debited 5,000 to cash is going out again. When we pay off the loan, the cash will go out of the business. So cash is credited 5,000. Let's quickly understand the logic. Now we have some normal or very common debit accounts and some common credit accounts. Debit accounts are usually expenses, losses or assets. These are called as debit accounts because they always have debit balances. Incomes, gains, liabilities and equity are credit accounts because they'll have a credit balance. Now what happens to these accounts? Whenever the debit accounts are debited, its value increases. And when the debit accounts are credited, its value will decrease. Let's cross verify. Cash. Now assets are debit accounts. Now cash, when it is debited, cash is coming in. Tuition fees received, cash is coming in. Cash is debited, cash is increasing. Asset is increasing. So when they are debited, it increases. Here we are making payment. Salary paid, cash is going out of the business. Loan paid, cash is going out of the business. Cash is credited, assets credited, balance goes down. So all the debit amounts or the debit accounts, when debited, increase, and when credited, they will decrease. Exactly opposite, the liabilities, incomes, gains or equity, those are the credit accounts. They will decrease when debited and increase when credited. Let's quickly cross verify. Tuition fees is an income. Income is a credit account. Tuition fees credited. Cash account debited to tuition fees credited. Tuition fees is coming in. Income is coming in. Income is increasing. Credit account is increasing when credited. Increases when credited. Loan account. Loan paid. So therefore loan is debited. Cash credited. Loan debited. Loan debited means the loan is paid off. Debited, loan is reduced. When you pay off 5,000, your total loan amount will decrease by 5,000. So when debited, it decreases. So I hope the concept is clear. Debit and credit, double entry system of accountancy. It affects minimum two accounts. All the debit accounts will increase when debited, decrease when credited. All the credit accounts will decrease when debited and increase when credited. That's all about debits and credits. Happy learning. Thank you.